Here's my number one hack about how to get a 3% mortgage rate, which could save you, of course, hundreds of dollars per month if you're looking to buy a house in 2024 and beyond. In today's video, I'm going to share the process about how this works, the pros and cons, and of course, how to find houses for sale using this special hack. Before we get started, if you guys get any value out of today's video, then please hit the like button. Also, consider subscribing as well. But let's just get to it because this is a very important topic because a lot of people are really frustrated regarding elevated prices and of course, elevated rates. We can't control prices so much. Let's talk about rates. This is based on an assumable mortgage. So what is an assumable mortgage? It is a mortgage in which a home buyer can assume, in other words, take over the current homeowner's mortgage loan, and the new buyer assumes the interest rate, the loan balance, and the principal interest payment. In other words, they assume the principal interest payment and not, of course, the home insurance and, of course, the property taxes. But they take on their P&I payment and all other terms of the loan, hence the name assumable mortgage. So let's talk a little bit more about this. And by the way, I'll share how to find these loans or these houses for sale that have an assumable loan. But first, what type of loans do this apply to? In general, VA, FHA, and USDA loans, which are all government-backed loans, in general have an assumable clause. In other words, the home buyer can assume the loan and of course, potentially get a much lower rate than today's prevailing rates. Also, if you own a home and you're not too sure what type of loan you have, call your loan officer or check page 4 of your closing disclosure that you signed prior to buying your house, which is this right here. Here's an example of your CD or closing disclosure. It's a 5-page document. Go to page 4. At the very top right there, it says, assumption. If you sell or transfer this property to another person, your lender, in this case, will not allow assumption of this loan on the original terms. Or if you do have a loan that's assumable, this box will be checked saying that it will allow this under certain conditions. I mention this because houses that do have an assumable loan clause that have a rate that are far below current rates today could sell at a premium. But let's talk about also the loans that are in general not assumable, and that is conventional loans. So in general, government-backed loans such as VA, FHA, and USDA loans can be assumable. Check with your lender or your loan servicer. But in general, conventional loans are not assumable by a new buyer. So how does this work? Number one, the buyer has to work with the homeowner's lender. In other words, you can't use your own lender to buy the house. You have to use the current homeowner's lender. Let me share a couple examples with you guys. Let's assume a home is listed for sale for $500,000. They have an FHA assumable loan. Here's the kicker. You have to ask the agent or ask your agent to ask the agent, what is the current loan balance, keyword current loan balance, that the seller owes on their house. Let's say their current loan balance is $450,000 and they have a 3% rate. Therefore, if you're a home buyer and you want to assume this loan, you have to pay $50,000 in cash out of pocket in order to buy this house. In other words, the difference between the sale price, in this case is the asking price, and the current loan balance of $450,000. Let me share another example. Let's say a house is listed for sale for $500,000. Again, with an FHA loan, the seller's current loan balance is only $300,000. This means their cash out of pocket is $200,000 in order to buy this house. So my question, of course, how many people actually have $200,000 in cash in order to buy a loan if they have a FHA loan they want to buy? So my question is, how many people would actually have $200,000 in cash if they want to buy a home using an FHA loan? My guess, it's probably minimal. Therefore, ideally, you want to find a home in which the homeowner just bought the house within the last couple of years, because you want to see the loan balance, the current loan balance, not too far less than the seller's asking price today. And again, that's because you have to pay cash out of pocket based on the sales price less the current loan balance that the homeowner has on their house. Let's talk about some cons first, and we'll talk about some pros, of course, as well. Number one con, the buyer may have to pay a lender assumption fee. According to Quicken, it may be a flat amount or a percentage of the unpaid principal balance. The fee can be charged, may be limited by state and laws and regulations, so check with your local jurisdiction. Personally, based on the Sacramento area, I've seen a lender assumption fee of around $900 for a $500,000 house. In contrast, if the lender does not require an appraisal or an origination fee, that could save the buyer hundreds of dollars though. So big picture, if you do have to pay a lender assumption fee, potentially you could save even more than that if you don't have to pay for an appraisal fee or a lender origination fee. There's a lot more cons. Let's kind of talk about that. So number one, you have to work with a seller's lender, and it's up to that lender whether or not they're going to approve you for the loan. You can't use your own lender to buy a house using this hack. Number two, it may take longer to buy a house compared to a traditional sale. So a traditional home sale, you can buy a house in California using a loan within around 20 to 30 days. But it could take several months if you want to buy a house and assume the homeowner's loan. And that's going to vary by the lender, so reach out to your agent about that. Number three, it could be hard to find these. And of course, some agents and sellers may not even be aware that the loan could be assumed by the new home buyer. Number four, and this is based on my own research looking at houses for sale that do have this assumable clause. There could be a limited amount of houses for sale with this clause. And again, it has to be government-backed loans in general. Number three, the home could sell at a premium, like I mentioned, because the buyer may be willing to pay over the asking price if they can get a much lower rate than current rates today. Number six, you will likely need to pay in cash. Again, the difference between the sales price and the current outstanding loan balance. And that, of course, that could be a significant amount of money, especially if the homeowner purchased the house several years ago. Number seven, and this is really a con for a home seller that has a VA loan. Because as a home seller, you could lose your VA entitlement if you let the buyer assume your loan. So according to Rocket Mortgage, it says if the new borrower has a sufficient VA loan entitlement, the seller can ask to officially substitute the entitlements. But if the new borrower doesn't have an adequate entitlement to make that substitution, then the seller's entitlement will remain attached to that house until the loan is paid off. In other words, when the new buyer would sell or refinance their mortgage. As a seller, it's critical to confirm whether the borrower has sufficient entitlements for a substitution. Otherwise, your VA entitlement would stay attached to this house and prevent you from using it elsewhere until that loan is paid off. And number eight, like I mentioned, the lender may charge an assumption fee, but you could save a lot more potentially if you do not have to pay for an appraisal or a loan origination fee. All right, that's the cons. Let's talk about the pros. Number one, of course, you could save a lot of money if you can take on a much lower rate than today's prevailing rates. I'll share a calculation example regarding that. Number two, for VA loans, you do not have to be a veteran to assume a VA loan. Check with the lender. Number three, like I mentioned, you could avoid these fees if you want to assume a loan. Let's talk about this example here. So let's say you're looking to buy a house. The purchase price is $500,000. It has an FHA assumable loan. The seller's current loan balance is $430,000. They have a 30-year fixed rate at 3.4%. Your P&A payment, if you were looking to buy a house and not assume a loan, would be around, let's just say, 7%. That payment would be $2,861 per month. But using the same example at 3.4%, your payment would be nearly $1,000 shy, $1,907 per month. That's a savings of a whopping $954 per month. Additionally, over the life of that 30-year fixed rate loan, you would pay around $600,000 in interest at a 7% rate versus only $257,000 at a 3.4% rate, a savings of a whopping $343,000. Of course, in this example, I'm assuming you're going to be having a 30-year loan. But of course, if you're assuming the current homeowner's loan, it could be 28 days, 27 days, however long they have on their loan. But just looking at big picture here, I mean, you could save hundreds of thousands of dollars if you can take on a much lower rate than today's rates, for example. So saving a lot of money per month, but also saving a lot of money over the life of the loan in interest paid for that loan. Lastly, how do you find a house for sale that potentially has an assumable loan? I'll share how to go onto Zillow and Realtor.com. However, though, if you're looking to buy a house in the greater Sacramento area, I have a search tied directly to our multiple listing service. So if you guys want to get on that list to get emailed any houses for sale that do have a potentially a assumable loan, then please email me at jason@meetjasonwalter.com. However, you can do it yourself as well, looking at these websites. For example, Realtor.com. Let's just say you're looking to buy a house in Portland, Oregon. My advice for you guys, keep it very, very broad because you probably won't see a whole lot of houses for sale. So for example, looking at Portland, Oregon, just keep the price range open. Look at houses, townhomes, whatever the kind of houses you're looking for. Let's just say you're open to townhomes, condos, and houses. But keep everything else open though. And at the very top, it says keyword search and type in assumable. Click on enter and then click on that. So just click on enter. It'll show all the houses that had this clause. So let's take a look at this one right here. $420,000 in Portland, Oregon. And it probably says here, yeah, look at this. Veteran special. So it's a VA loan. Assume the seller's 3.25% interest rate. Pretty crazy, right? Go back. Let's look at these other ones. First one right here and scroll down. It says, be the first to live in this freshly renovated home with the option for an assumable loan at 3.75%. That's basically like half the rate we're seeing today, which is in November of 2024. So that's how you look at houses for sale that do have this clause. But don't get tricked here because some of these are ads, so new houses for sale, and also some of these are pending as well. So all these are pending below. So look at houses that are for sale, of course, or condos for sale. So that's looking at Realtor.com. Let's take a look at Zillow, for example. Look at, I don't know, Manor, Texas. I don't know why I looked at Manor, Texas, but look at houses for sale, of course, not for rent, not sold. Again, keep it very, very broad, and then click on more, and then scroll all the way to the bottom here. Let's see, yeah, look at coming soon as well. Scroll to the bottom and then type in assumable, apply, and you can see all the houses for sale that have this assumable clause. The first one that pops up is this one. They just had a price cut of $10,000. Sometime I've seen houses for sale in which the homeowner lists their home for far more than market value, thinking that there's going to be a line out the door for people who want to buy this house because they can assume their very low rate. But in my experience based in the Sacramento area, I'm seeing houses that only have 1 to 2 offers on average. So it's not like you're getting 20 offers on the house. Of course, that could vary, of course, right? So this one right here, rare opportunity, assumable 2.5% loan. How crazy is that? So if you want to get this house, buy it. For example, again, take this sales price and you have to find out what's the current loan balance that the homeowner owns on their house, excuse me. The difference on that is a cash out of pocket to buy the house. And again, this likely will not work unless the homeowner bought the house within the last couple of years, because if they bought the house 10 years ago, likely their loan balance would be a lot less than their current asking price today. So again, it might not make sense to buy a house using hundreds of thousands of dollars just to get to a low rate. Focus on houses in which the homeowner just purchased a house within the last couple of years. With that said, if you guys got any value out of today's video, then please hit the like button. Also, leave me a comment below. If you guys search for houses using this special hack, how many houses do you actually find that are for sale. Please leave a comment below. I appreciate you guys so much for watching today's video. Please like and subscribe, and we'll see you in the next video.